Warren Buffett is one of the richest in the world today. He is a successful investor, businessman, and philanthropist. Over the years, Warren has given various tips and advice on investing and building wealth. With more than 80 years of experience in investing, you can only imagine how valuable and timeless his suggestions and strategies are. In this video, we will discuss some of the most important investing tips from Warren Buffett. So stay tuned because we will discuss how you can also apply these tips in your investing journey today so you can also become successful as well. So make sure to watch this video to the end. This is Financial Intellect, where we promote that to be finance savvy, we are your buddy. Now let's get right into the video. Tip number 1. Only invest in what you can understand. Investing in something you don't understand is one of the most common mistakes investors make. If you know nothing about the business or it's too complicated for you to understand, then it is better to just stay away from it. This advice is not only applicable to the stock market. This is also applicable to other types of investment such as cryptocurrency, gold, and real estate. While these investments may work for some, it doesn't mean that they will also work for you. When it comes to stocks, just remember to never invest your money without first getting a thorough understanding of the business, its business model, and how it is making its money. Tip number 2. Do not overlook quality. This step is more difficult to do than sticking to buying what you only understand. You need to understand that it is important to know whether you're buying a high-quality asset. A stock or industry that is priced cheaply is not always a good opportunity for investors. Most investors are often tempted to buy stocks at extremely low prices because of possible high dividend yields. But remember, high-quality assets don't often go on sale. So you're probably better off spending a little bit more money just to buy that high-quality stock than trying to cheap out for a low-quality stock. The higher price you paid for that high-quality stock will be more profitable in the long run. Tip number 3. Buy stocks with the intention of holding them forever. Once you buy a high-quality asset, Warren recommends holding it forever. If you're not considering holding it for at least 10 years, then just don't buy the asset at all. The reason for this is that it will be more profitable in the long run. Buying stocks you do not know is already risky, and constantly buying and selling stocks is also not profitable since taxes will just eat away most of your returns. Remember, it is normal for prices to fluctuate. Even those high-quality companies will hit some bumps along the way. But remember, the higher quality the asset is, the less will it be susceptible to a market crash. Tip number 4. Often, news is just noise. Warren believes that investors should not always believe in the news headlines. If you want to know about the stock market, just take a look at the market itself and see for yourself how it is performing. Do not just blindly rely on the news. Even when it comes to individual stocks, do not also believe everything that the news tells you. The long-term trend is upwards, so in the next 5 to 10 years, you can still earn significant returns from your investments. The news we often hear on TV or even YouTube is exaggerated. They are phrased in such a way that it would trigger emotions. Higher emotions get more views, which means higher ratings as well. So their stories don't really matter in the long run, so don't take them seriously. Now, before we move on to the next tip, if you love content such as this, kindly give this video a like, subscribe to the channel, and turn on the notification bell so that you will know when we've posted new videos. We'd love to be part of your financial journey. Now moving on to the next tip. Tip number 5. Diversification is not always good. Diversifying your portfolio is probably one of the most common pieces of advice you will often hear. This can be a good idea if you're the type of investor who does not know much about the market. But for Warren, he believes in putting a large amount of money into one particular asset before diversifying across companies in various industries. Let's take, for example, Berkshire Hathaway. It has around 40% of its assets invested in Apple stocks. The problem with some investors is that they overly diversify. The challenge with this is that it will be more difficult to keep track of your investments if you have too many stocks in your portfolio. It is fine to own 1, 2, or even 3 stocks, but having more than that is too much. You're over-diversifying. How can you keep up with all of them? Tip number 6. Price and value are not always correlated. Information on stock prices is easy to find, but what is more important is finding the fundamentals of a company. Stock prices don't tell everything about a company. Remember that most of the time, stocks are either overpriced or underpriced. But these prices don't indicate the value of the company. During recessions, notice that the stock market is often on sale. People are selling their stocks and sometimes at a very low price. And when the company is booming, everyone is also buying, even if the prices are overinflated. But you have to understand that prices are different from their value. Most of the time, stocks are priced way above their value and sometimes way below. You need to know how to determine the value of the company. This will help you decide if the price is too low or too high. And this will prevent you from making any bad investments. Tip number 7. The best moves are not always fun. If your goal is to get rich instantly, then investing in the stock market is probably not for you. The stock market is designed to get the most return the longer you hold the stocks. This is why investing in the stock market is boring sometimes. As an investor, your goal should be to find companies with steady growth. This will allow your investment to compound over and over. While it may be tempting to invest in something that has a high potential to make you rich quickly, think of it as something similar to a lottery. If you already have a good portfolio, don't risk it all away. If something appears too good, don't let your emotions get the best of you. Think hard and remember that the best moves in the stock market can sometimes be boring. Tip number 8. Investing is not hard to understand. Contrary to popular belief, investing in the stock market is not only reserved for professional investors. Even you can invest and be successful in choosing the right stocks. What makes the stock market so hard for most investors is that they jump into it without fully understanding the market. They know very little about what they are buying, and they don't even put in the effort and time to conduct proper research. Investing is not a game reserved for highly intelligent individuals alone. You can also do it and be successful in it. Just understand that there are no shortcuts in investing. There's no single magic formula to beat the market and make it big. Just do your research and put in the effort, and your investments will eventually succeed. Tip number 9. Index funds are more suitable for most investors. Most investors fail because of various reasons. Sometimes they are too emotional, and sometimes they just take too many risks in something they don't know much about. But according to Warren, choosing a profitable and safe investment does not have to be so complicated. Maybe buying individual stocks is just not for you. What will work for you instead is an S&P 500 index fund. For most investors, this is a great alternative to individual stocks. S&P 500 Index Fund is the best option for you if you don't have time or you just don't want to complicate yourself with learning about all those investment stuff. The funds offer long-term returns that are much higher than that of pension funds, individuals, and institutions. It also has an average return of about 10 years, so this is a great option. And those are some of the critical investing tips from Warren Buffett. Stick to what you know, invest with a long-term mindset, and avoid being overly emotional. So long as you practice all of these tips, then you can also be successful in investing. Now, what do you think of Warren's tips? Do you agree with his principles, or do you have other ideas in mind? Let us know in the comment section below. We'd love to hear your thoughts on this. And with that, thank you very much for watching. If you like what you've watched, stay tuned for more videos. Bye, financial buddies!